Hey everybody, Smart Silver Stacker here. Hope you're doing well. Welcome to another live stream. The US economy is not doing as well as we are being told, and I believe we received a confirmation of that today when the Federal Reserve, at their FOMC meeting, paused their series of rate hikes. Now, this headline from NBC I find to be pretty interesting. Federal Reserve pauses rate hikes as inflation slows down. And there was a lot of talk, if you watched the FOMC press conference with Jerome Powell, about how inflation is slowing down. It's on the decline. But, it's very interesting when you look at the numbers. Got this graphic here on this page. Inflation is down from the peaks, but is it moving down now? I mean, if you look, 3%, 3.2%, 3.7%, the most recent headline CPI number from August, looks to me like inflation is on the way back up, not like inflation is under control. Keep in mind the Fed's target rate, 2%. So we are now moving steadily away from that in the headline CPI. So what's all this talk about inflation being down? And if inflation is headed back up, which if you just look at the numbers, it is, why is the Fed pausing their rate hikes here? Because you would think, inflation's moving back up, they might get a little tighter, they might be a little more hawkish. Well, I believe that the reasoning behind this is because the Fed is concerned about collapsing this weakened U.S. economy, this economy that is being held together. It's being powered by a consumer who is at the end of their rope. And Jerome Powell and the FOMC, they understand that if they were to hike rates today, they could create a massive crisis. And we're going to get into some of the signs of the weakness in the U.S. economy here. We'll also talk about the effect of this hike, or lack of hike, I guess you could say, on the price of gold and silver. Today's video is brought to us by sdbullion.com. Buy your gold and silver at sdbullion.com. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. And if we look at the silver price here on SD Bullion, you can see that today, initially, silver was having a pretty good day, but then kind of fell apart by the end of the day there. We'll talk about that briefly. But first, I want to get into something that Jerome Powell said here, which I think was very telling, his response. There was one of the members of the press who asked Jerome Powell about the rising credit card debt here in the U.S. So we got energy prices on the way up, gasoline on the way up, and the question was something along the lines of the U.S. consumer is putting these additional charges on their credit cards. Are you concerned about a credit debt bubble, a consumer debt bubble? And Jerome Powell was very dismissive of this question. And he pointed out, rightly in some ways, that currently the delinquencies and signs of consumer stress are on the rise, but it's from a very low level. And he pointed out that recently these signs of consumer distress had hit an all-time low, which is true. This is from the St. Louis Fed delinquency rate on credit card loans from all commercial banks. And you can see this did hit an all-time low following the pandemic stimulus. Folks were getting stimulus checks, so they weren't being forced to default on their credit card debt. And Powell pointed out that while this is rising, it is only rising to pre-pandemic norms. Now, the latest reading on here, 2.77. The pre-pandemic peak was 2.66. So to get back to a level where we're as high as we're at, you actually have to go back to pre-2015. But there are some other metrics that show that consumers are not necessarily just returning to pre-pandemic norms for consumer distress. One thing we can look at is just the total balance on credit cards. So prior to the pandemic, the total balance on credit cards had hit something like 850 billion. Well, now we're up over $1 trillion. So when you look at this chart, you can see there was that dip there as everybody was getting stimulus checks, but now we have surpassed pre-pandemic highs in terms of total balances, even though delinquency rates now have simply returned to pre-pandemic norms. And this delinquency rate is going to be something to keep an eye on. I think this is going to be one of the things that puts some stress on the banking system as we experience these higher rates. Because keep in mind, the balance is at an all-time high, and also rates on these credit card balances are much higher now than they were pre-pandemic. So to say that we're just getting back to a pre-pandemic situation in terms of consumer pain, I think, is a little disingenuous. But of course, Powell needs to downplay that as he pursues this policy of continuing to hike rates. I mean, they did pause today. They didn't hike at the FOMC meeting, but they did indicate that there would be more hikes in store as the year goes on. At least one hike. That seemed to be the consensus among the FOMC members. And who knows? I mean, we may see two. There's still two FOMC meetings. But when they do resume these hikes, I really believe there's going to be some significant pain in the U.S. economy. And ultimately, that means that the Fed is going to be forced to reverse their policy of hikes, but it's going to get a lot uglier before that happens. Now, here's another sign, and this is a very strange one, that U.S. consumers are at the end of their rope. This is a story from CNBC. Weekly mortgage demand increases driven by a strange surge in refinancing. So we're seeing mortgage rates moving up, and according to this article, applications to refinance home loans jumped 13% last week compared with the previous week. So that's very unusual that you would see refinancing moving up at the same time that mortgage rates are increasing. Now, one of the things they point out here is that refinancing is still lower than it was for the same week last year. And of course, I mean, the rates on the mortgage refinances are much higher now than they were a year ago. So it makes sense that they would be lower. But a 13% spike in a week is very significant. And I believe that the reason is it's not because people want to take out loans at a higher rate of interest. They don't want to pay more interest. That's one of the potential theories here that they pose in this article, is that perhaps borrowers just are concerned that rates could go even higher. So they're going to take advantage of the lower rates that we have today. But that doesn't make a lot of sense, I don't think. And the real reason here is, again, because consumers are financing all of their spending with debt. Powell even acknowledged in the press conference that the increases that we've seen in GDP have primarily been driven by consumer spending. And I don't think that that's because people are out buying big screen TVs and iPhones and, expensive consumer goods. It's a sign that the price of filling up your gas tank or buying a cart full of groceries has gotten to the point that you can't do it without borrowing more money. And so I think that this sudden spike that we've seen in refinancing is just a sign that consumers are using whatever they can, and now they're using the equity in their homes to pay for the increased cost of living. I mean, if you've been to a grocery store lately, or if you filled up your tank, you understand that inflation is far from beaten, despite what the Federal Reserve might tell you at their FOMC meeting. I do want to talk a bit about crude oil as well in today's live stream. We're going to kind of go far afield here, but one thing I think that we should be paying attention to is the price of crude oil. This is the 6-month chart for crude, and you can see that from back in July, we had a low of $67 in crude oil, and we've moved up. I mean, right now it's under 90. We had a little bit of a correction today, slight pullback, but still a very big move up, and it did go over 90. So it was more than a 34% increase between July and now. And now a lot of this has to do with the Saudis and the Russians cutting supply. Certainly, we might experience more of that as the geopolitical situation devolves. But the thing that I want to pay attention to here is, there's these signs of impending economic weakness. I think we may be in for a bit of a correction in the price of crude oil. So one thing I did today, and none of this is financial advice, I'm just telling you what I'm doing. I actually lightened up on some positions that I had in energy stocks because I think that, after a 34% run up in a very short period of time, we should be wary of, getting greedy here. And I think that some of these energy stocks maybe are due for a bit of a pullback. So I lightened up on those. We'll see how that goes. But I do think that we are, seeing signs of weakness. We may be on the verge of a bit of a recessionary sell-off. I think that that is confirmed by the fact that the Fed, despite rising inflation, has decided to pause their rate hikes today. And, the oil thing has gotten a little overextended. Long term, I am pretty bullish on the price of crude oil and energy. It's gone very, a very period of time. I think that's something we should all be aware. Thing that Powell mentioned was that despite hiking rates at this meeting, they are continuing. Now, you can they still have a way to go before they unwind even the pre-pandemic stimulus, or I'm sorry, the pandemic stimulus, let alone the massive amounts of QE that had gone on for a decade plus before that, starting with the great choices. But they're down to almost $8 trillion. I think their balance sheet now is like at 8.08 trillion. And, one of the things I've been calling for a long time is that the Fed isn't going to be able to get this under 8 trillion. Yeah, that's not the most recent number. It's hard on this tablet. There we go. Anyway, they're down to just over $8 trillion on their balance sheet. And he was emphatic that they're going to continue to lighten up on that. But, I mean, they're certainly taking their time on it. And I don't know, maybe they will be able to get this under $8 trillion. But even if they do, this peaked just under 9. So even if they are able to get this down to 8 trillion, that only represents a very small portion of the total post-pandemic stimulus. They still have a long way to go before they get down to the 4 trillion or so mark that they were at pre-pandemic. And so, I think again, this is more or less just kind of like lip service to their inflation fight. If the Fed really wanted to fight inflation in a significant way, they would be selling these assets off at a faster pace. And of course, this is the real inflation right here. This is the debt monetization. This is the expansion of the money supply. And with the federal government running deficits of the magnitude that it is right now, I'm still pretty confident that we're going to see $10 trillion on this Fed balance sheet in the relatively near future. I don't have a crystal ball. I'm just some guy on YouTube. But I do think that we are going to see a massive expansion of this Fed balance sheet once we start to really see some weakness in this economy. Maybe before the end of the year. It's very possible that the Fed, one of the things that Powell said at the conference was he reiterated several times that it is data dependent and that they will adjust their as the economic situation to develop and to play out. And so, if we get some significant weakness in the economy, if we get a big asset sell off, if we get a crash in the stock market, if we see some major banks fail, if the U.S. consumer just can't, if he starts defaulting or he or she starts defaulting on those consumer loans in a significant way, then I do believe we will see a much more accommodative Fed. The way that they laid things out at the FOMC today was that there would be further rate hikes this year, at least one, and then it sounded like there would be rate cuts by the end of 2024, according to what the Fed is, forecasting at this meeting. But I think we're going to see rate cuts before then, certainly, and probably in a significantly larger magnitude than what the Fed was discussing. I think they said cutting the rate, their forecast was to cut the rate down to 5.1%, the federal funds rate, by the end of 2024. But again, he emphasized repeatedly that could change, if the economic data changes, and I think it will. Here's a piece from the Wall Street Journal, pretty interesting. Why a soft landing could prove elusive. Odds of the Fed reducing inflation without a recession have improved, but hazards loom. And yeah, they keep talking about the possibility of a soft landing. Powell today did state that was the Fed's goal. But, this article points out that since World War II, the U.S. has achieved only one durable soft landing in 1995. And here's a quote from Alan Blinder. He was an economist who was Fed vice chair from 1994 to 1996. He said, "We steered the economy very expertly, but in addition, we were lucky. Nothing bad happened." So, yeah, what are the chances that nothing bad is going to happen in this economy? This is a very different economy than what the US had in 1995. I mean, the national debt alone is orders of magnitude larger. The deficits are massively larger. Inflation is higher than it was in the mid 90s. More going against the US economy at this time, which is, again, indicative, I think, that the Fed's pause today is because of fear. Powell understands that the U.S. economy is in a bad position. And, one of the things that the U.S. has going against its economy right now is the ongoing geopolitical problems. Here's a headline from Reuters: Putin and Xi to meet in Beijing in October, Russia says. So Xi Jinping has invited Vladimir Putin to, oh, and here's a picture of these two gentlemen. Hadn't loaded yet. Yeah, these two guys. Yeah, this is another problem for the U.S. economy. They're meeting the Belt and Road Initiative conference that's going to be held in China. And, this geopolitical situation that we have, we've got Japan selling U.S. Treasury bonds. They're the biggest foreign holder of U.S. Treasuries. They're selling them to defend their currency, which is collapsing. You have China, who is unloading over the past year more than $100 billion worth of treasuries, U.S. treasuries. They are doing this both to defend their currency and because of their fears of a weaponized dollar. So there are multiple factors contributing to a U.S. bond sell-off by the second largest holder of foreign treasuries, that's China. You also have Russia out there campaigning to de-dollarize the world, and that is likely what will be discussed at this BRI meeting. The BRI, the Belt and Road Initiative, is sort of like the de-dollarization highway. It is the means by which bilateral trade will occur among these nations using currencies other than the US dollar. So this is going to be very bad for inflation. So even as the US economy continues to weaken, we are going to see inflation ultimately continue to move higher as a result of de-dollarization. And so, this is just a very different environment from 1995, and I really don't think the Fed is going to be able to pull off this soft landing. Much more likely, we're going to see a very hard landing indeed when something in this massively over-leveraged economy breaks in the face of rising interest rates, and that is when you're going to see the Fed being forced to reverse policy despite the fact that inflation remains high. So we've seen what happens when the Fed stimulates when inflation is low. In the great financial crisis and in 2020, inflation wasn't really a problem yet, but the Fed monetized a huge amount of debt, and that caused inflation to soar. Now, they are on this quest to hike rates to bring inflation down. It's not working, despite what we hear. I mean, you've seen the numbers, the headline CPI on the rise for the past couple months. Once again, the disinflation trend is over. And meanwhile, you've got this very unfriendly geopolitical situation going on around the world as well, which is very bad for the dollar and its status as the world reserve currency. And, one of the big weaknesses that we all have to keep an eye on in this year of 2023, when we've already had massive bank failures, is the banking sector. And the 10-year yield here is continuing to remain very elevated. This has moved significantly higher off of its lows, now up over 4%. Every time this 10-year yield increases, every time the yield on U.S. Treasuries increases, you have to understand this is putting a lot of pressure on the U.S. banking sector. The U.S. banking sector has large portfolios of low-yielding U.S. Treasuries. It's part of why SVB failed earlier this year. So every time you see this hike up, the banks are losing money on paper. They are taking larger unrealized paper losses. And ultimately, if they see a run to liquidity, if they see a liquidity problem, if they see depositors pulling out their deposits and they're forced to sell those bonds, just like what happened to SVB earlier this year, we are going to see significant disruption in the US banking sector. So, all of these things are reasons why the Fed paused their rate hikes. It's all a significant deflationary sell off that will bring in inflation like you've never seen before. So, I want to be clear on that when I caution, and I've cautioned against this in a few videos, the potential for a significant sell off in the price of precious metals, which I think could very well happen. It doesn't mean that I'm bearish on the metals. I mean, I'm still stacking. I've got some 90% silver half dollars right now in the mail coming from SD Bullion because I'm continuing to average into hard assets outside of this financial system. Because ultimately, when we do get that deflationary crisis or a major sell off or something in this over leveraged economy breaks as the Fed continues to hike, their response is going to be to print money. I'm fairly convinced of that. I mean, leave me a comment down below or in the chat today if you disagree with that, if you think the Fed is going to let a recession just run its course naturally. But I don't see it. I mean, nothing in the Fed's behavior over the past several decades would indicate that that will be their reaction. And on top of that, you've got politicians, like Elizabeth Warren, who are modern monetary theorists. They think that the Fed should already be cutting rates. They think that the Fed already is too tight. And when we start to see significant layoffs, when we see banks failing, when we see the repercussions of these higher rates in this over-leveraged economy, then those voices are going to be amplified in a tremendous way. And they're going to sell the stimulus to everybody. I mean, they'll probably be sending out checks. Everybody likes that. It's not going to be a hard sell, I don't think. It's very politically viable to cut rates. It's always a popular move, easy money, until inflation runs out of control. But I do believe that the Fed will disregard the risk of runaway inflation when the economy really begins to degenerate. And that is beginning. That is around the corner. There are many, many signs of it. And today's pause by the Fed, I think, is just one more sign that this economy is not in good shape. So leave me a comment down below to let me know what you think. Where will the Fed go next? What's going to happen with the U.S. economy in this environment of sustained higher rates? Do you think the Fed's going to hike at the next meeting? How many more hikes do we get before the end of the year? I always like to hear feedback from you, so leave me a comment down below to let me know what you think. Thanks for watching, everybody. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker, out.